Testing, testing. Can anybody hear okay? Is the sound coming out clear without any distortion or anything? Okay, great, great, excellent. Well, I'll tell you, I am in Florida, but it feels like it's New York. It is cold here, cold and damp today. We had a cold weather front. It might have hit you out in Mobile too, Morgan. I went out for some pizza before this presentation, and I thought I was in New York City. It was really cold. So usually we talk sunny Florida. It's overcast and cold today. So we're going to get rolling right into my presentation. And to some extent, you can thank my buddy Morgan for the title of this presentation, Blues Money Machine. I've done presentations like this before, and he'll come up with some catchy titles for me. Um, so we, hey Doug. So we come up with a little bit of fun every once in a while. One of the things I learned a long time ago about trading was after you trade for a while, it's fun, but it gets kind of boring. So as you start getting profitability, you should be a machine, and I kind of am. You kind of become automatic with your trading, and uh, and so I have a little bit of humor or fun as I move along as a trader because you have to. And it's also a good way to release stress or reduce stress because trading can be stressful, particularly for new people as well. I do have a link here for you to these slides. I had a little trouble with the PDF, so I put it in PowerPoint for you. It's in Dropbox. You ought to be able to click on that link right there that I just put in the chat and get it. And Morgan, if you want, you can cut and paste that and put it into the announcements too so they can get a copy of the slides. Again, if you have trouble opening them, just convert them to a PDF. Some reason my PDFer wasn't working. All right, so let's get right into this. First, let's talk about our risk disclaimer real quick. And as you're reading this, I'll give you my take on risk and disclaiming. Basically, I feel, and all of you are here doing this, get as educated as you can, but don't get overwhelmed by education. So get a good education. The second thing for risk, I think, is learn and apply good risk management skills. That's the second thing I think is important. And finally, the third thing that I think is important is managing your emotions. So if you can get a decent education, you learn how to apply risk management accurately and consistently, and you learn how to manage your emotions, you tend to do fairly well, and you reduce the risk as far as any human can reduce it. Now, I use this term blue, and my nickname for a long time has been Blue Horseshoe. In fact, I am the true Blue Horseshoe, even though you see many imitators in chats and on the web. And basically, Blue Horseshoe, for those of you who may be younger than I am, is a reference to a line in the initial Wall Street movie, and it was a person in at the Wall Street Journal who would leak tips on stocks that were on the move. And Gordon Gekko, he was one of the protagonists in there, and Bud Fox, Bud Fox would call this information in and then they'd move different stocks. So it's kind of like having an insider's look into stocks. So I feel like when you're an options trader and you look at options open interest and you look at volume, you've kind of got that insider's look at stocks. And the famous quote, the quote that made Blue Horseshoe famous was a quote where Bud Fox calls up the Wall Street Journal and says, Blue Horseshoe loves Anacott steel. And then they manipulate Anacott steel. So just so you can get a little bit of that old-fashioned information that those of you who might be younger than 30 may not know, or 40. But a good movie if you've never seen it. And the new one, Money Never Sleeps, or Markets Never Sleep. Money Never Sleeps is the new Wall Street movie. Markets Never Sleep is Tom Busby's book. So it's kind of an interesting thing. I'm a clinical psychologist. I'm also a professional options trader. I've been doing this for a number of years. It's how I create my retirement. Psychologists, despite all our education, don't get paid real well, so you have to figure out another way to generate capital for your retirement. And I do a lot of stuff with human performance now, brainwave treatments, really heavy into that, and I'm slowly moving more and more into that as a practice. So just know I have a strong clinical background. So if I make an occasional reference to psychology, I have the background to back it up. All right, let's get right into this. One of the things I always look at on a regular basis is the indicators of market direction. And I think that's important for anybody, okay? So it's always very, very important for you to think about what the markets are doing before you take any trades. And I'm not going to belabor this, but I'll show you a couple things about the market over the past week. And what I'm going to do here today is show you kind of a money machine to generate money. And what I found over the years has been a pretty consistent way of generating returns in a very, very simple, with some simple option strategies. So I think it's important to look at put-call ratios versus how the market's doing. We'll look at that real quickly. Look at the volatility index because it tells you an idea of how much complacency or fear is in the markets, and also look at the general direction of the futures. So taking us right to the put-call ratio, we're going to jump right in here. The blue line is the put-call ratio. The black line is the S&P 500, okay? And basically, what the put-call ratio is they take all the puts, they put them over all the calls, and basically get a fraction or a ratio. If it's 1 or above, it means that the market's becoming more bearish. If it's below 1, it means the market's becoming more bullish. And basically, if you think about your old learning about fractions in high school and elementary school, you put one number above the other number and you get a fraction. And that's all this is. And this was just the last snapshot from last night. And you can see how the S&P had been going down, but the put-call ratio had been really taking off. Now, one of the things you look at with this is extremes. Notice we had an extreme right here on the put-call ratio, and look at what happened to the market. The market had a correction at the same time. Now you can see we're getting another extreme, and this is an extreme in the put-call ratio. You can see where the mean is right there. The mean is 1, and now you're 2 standard deviations above the mean, and then of course here was 2 standard deviations below the mean. A standard deviation accounts for a large percentage of the move away from the average. So basically we're having pretty significant move away from the average on the put-call ratio, saying that we're probably getting a little bit overloaded on the put side, a little bit on the fear side, and that's telling me that reasonably soon we're going to have the market settle down. And in fact, you can see Friday the market bounced up some. And also last week is options expiration, and I wouldn't be surprised to see a little bounce into expiration and also see the put-call ratio slow down into expiration. A lot of times these folks are loading puts into the next month. So, and you can get that in the file that I shared with you. If you look at the bottom on the notes section, it's got the links to all these charts. So if you want to look at this yourself or retrieve it every day, you can retrieve it. So all the information here is on the bottom of my chart, bottom of my slides if you need it. All right, that being said, the VIX. The VIX is basically an index, a volatility index, and I'll show you a couple of trades on this as well as we move along here. But basically, you can see that we had a high on the VIX here, a high on the VIX here in March, and then we had hit a high a day ago, and this is the most recent chart. This is from Friday. And you can see how the VIX is coming back down. So if we continue the patterns, you think about the put-call ratio being at the extreme, and you see the VIX starting to come back down, it's possible that this market now has finished with its correction, or it's going to do a little bit more chopping around for a couple more days, and then we'll settle down. So I'm trying to get an idea of what the larger term direction is. I do this for 2 reasons. One reason is because day to day I like to know where the sentiment of the market is. Number 2, I do short-term trades, day trades, and longer-term trades or portfolio trades, and I like to have an idea where I think the market's going if I'm going to take a little bit longer-term swing trade. And that's why I think these are good. Plus, it gives you an idea what the bias of the market is for the day. That being said, let's move to the E-mini here, and this is basically the E-mini futures. Thank you. Thank you for throwing that link up there again. I'm trying to keep really rolling here so we don't fall behind. I know everything's falling behind a little bit. And then I'll slow down when I actually talk about some of the trades. Here's the E-minis, and this is basically a quantitative chart. I got the link for this too. And basically what you see on the top is a candlestick chart. The white line is the 13 exponential moving average. Of course, these are just standard candles, you know, positive or negative, up or down candles. And then you can see the red line and the green line. That'll convert to red when the market starts to turn negative. It'll convert to green when it's turning positive. And basically all it's telling me is, okay, we're below the 13 EMA. If I'm below the 13 EMA, I'm going to think the market's weaker. If it's above the 13 EMA, it's stronger. And then down here is the computerized analysis, which is called the quantitative analysis. And basically you can see it goes in patterns of 1, 2, 3, 4, 5, 6, 7, 8. Sometimes if it gets overextended, it'll have a couple more, then it'll change. And so when I'm looking at this right now with the S&P, what I see is that the S&P has turned negative. Okay, we've got 1, 2, 3, 4. You can see the red. And now we have a green here with a red bar. This is telling me that the market might be down a couple more days, but it's getting ready to turn around, kind of like you have right in here. Now, again, I'm not here to explain this to you. You can go to that website and learn all about it. This is just one of the charts that I use when I'm doing this. I use a lot of different charts. I tend to use this and e-signal a lot for looking at the trades and my options, at least longer term trades. Day trades, I'll look at an intraday chart. But these are all daily charts. And as long as this is below the center line here, and this is not a MACD or anything, it's actually a quantitative analysis of several indicators that are proprietary by their company. But the bottom line is I'm seeing here, what I'm looking at here from Friday is, it looks like the market's trying to reverse itself back up, but we're still kind of in a downward motion. So that being said, I'm not going to get too aggressive to the long side until I see things bottom out and start to move back the other direction. And again, you can see that the market still is below the 13 EMA. And because it is, it tells me to exercise caution and to just be patient before I execute a few longs. Here's the weekly E-mini, and I wanted to show you the weekly E-mini. This one's from eSignal, this chart. And what I just wanted to show here with this red line is this vertical line. Notice that's a 13 EMA. And you can see how we have a little tail on the candle at the bottom here, hitting that green 13 EMA. And that's basically telling me that we could be starting to get support in here. Worst case scenario, and I've analyzed this market, worst case scenario, we pull back down to about 1,500. I don't think we're coming all the way down here to, a 50-day moving average or a 100-day moving average. I don't think we're going to go that far. I think 1,500, 1,490 is going to be low, if it even goes that far. But you can see every time it pulled back, basically since January, the 13 EMA on the weekly chart is support. So I'm seeing a lot of things. I'm looking at the VIX coming down. I'm looking at the put-call ratio as a high. And I'm looking at the quantitative analysis, all telling me essentially that this market is starting to slow down on the downside. We may have another day or two. It might just do one of those quick stabs to 1,500, 1,490 to scare everybody out, and it'll head back up. So I don't think it's the end of the world yet. But I just want you to know that I look at these things. These are the things I look at as I'm thinking about trades. Also, I will trade a stock long in a bearish market if it's an extremely strong stock. So I look at both the market pattern and the stock pattern. And just here's the NASDAQ, because we looked at the E-mini. And you can see the NASDAQ is a little bit weaker than the E-mini, but a similar kind of pattern. Kind of broke down below the 13 EMA. You can see we're negative on the quantitative analysis. And again, it's telling me, and remember, we have Apple coming out. Apple's coming out this week. Netflix is coming out this week. We've got several NASDAQ stocks, Baidu, Amazon. Netflix is coming out on the 22nd. Apple's the 23rd. All these things are coming out, and they could be the impetus to run this market back up on the NASDAQ. And again, I'll just be patient and see where it goes. And then here's the weekly again, and the same type of thing. You can see the weekly, how you have a tail again on a moving average. That's the 20-day moving average. So basically, again, we're seeing that it's starting to hit starting to hit support at those moving averages. And honestly, when you look at these moving averages, you always think about barriers or resistances, and I like to think of these as barriers. Supports and resistances are barriers, and there's a lot of ways to read this. But I'm keeping it very, very simple here. What I want to tell you is I look at what the put-call ratios are doing as an options trader. I look at what the VIX is doing of volatility, and then I look at what the markets are doing. And I can actually see that they're kind of going together. They're all kind of going together. So we may have one or two more down days or sideways days, might stab down to that 1,500, and then that's going to look to be a fairly good buying point or positioning point at that point in time. And it may be coming, toward the end of next week. It could be coming toward the end of the month. Oftentimes the end and the beginning of the months are bullish. So I think, just be patient if you want to take a few long positions, and you'll get some opportunities. Now, Blue's Money Machine often uses just a couple of different strategies. Many times Blue's strategies are credit spreads. So I'm going to briefly go over a call credit spread and a put credit spread, and then the combinations of these spreads. And an iron condor is one of the combinations. And I find with just these two strategies and combining these two strategies, you can be pretty effective in getting returns in options. So options don't have to be very difficult. You can get nice, consistent returns. You just have to think about where the market's going and be a good chart reader. You have so many wonderful people here at the TradingPub that I see from time to time. I can't always be here, but they do a really good job of helping you predict market direction or stock direction. If you can, then it's just a question of taking the trade and doing good risk management. It's not as hard as you might think it might be. I think the difficult part sometimes is the management of your emotions. Okay, so a vertical bear call credit spread, basically what you're doing is you're buying and selling two out of the money calls. Now, sometimes I'll use an at the money call on the short side, if I'm doing a momentum trade after earnings, I'll show you one of those, or I'll talk about one of those later on. But typically, I'll use 2 out-of-the-money calls. I can be 1 to 3 months out. Now, with these weekly, the new weekly options, sometimes I'll do a weekly as well and only be 1 week out. And weekly options, I think you have to understand some of the parameters of the weekly options. So I'm kind of keeping this straightforward for people who might even be more new to options, so I don't get into too more of the riskier strategies. I think that doing a monthly option, in at least my opinion, is less risky than doing a weekly option unless you understand the weekly options. You basically use the same number of options on each leg, and we'll look at several examples of this. And you want to make some money on this. So when you sell a call, or you sell a put, or you do a credit spread, you're bringing some money into your pocket. The easiest way to remember this is think about insurance companies. You know, if you're a car insurance company or a homeowner's insurance company, basically what you do is I give you a premium, and then you take in that premium, and then for that premium, you're providing me with a contract of insurance on my house. Well, basically, with a credit spread or with selling puts or calls, we are basically letting people sell us the premium. So we bring in the premium. We're like the insurance company. We take it in, and then we hold that premium. And assuming there's no hurricane or there's no flood or fire, we get to keep that premium. Well, the same thing here. As long as our short call or put stays out of the money, we keep that whole premium. And I'll be honest with you. Would you rather be the insurance company, or would you rather be the guy paying the insurance? I have collected on my insurance, both positive and negative there, because you really don't want to have floods or fires to collect on your insurance. But, you know, dollar for dollar, I'm not the guy with the big fancy buildings and the millions of dollars or billions of dollars. It's the insurance companies. So you want to think like the brokerage firms. You want to think like the insurance companies. And so therefore, it's better to sell premium than to buy premium, although I do both, just to let you know. But these make pretty nice income generating trades, and that's why I like them. And I won't go into a whole lot of detail with why I use these. I have other presentations about that. I just want to give you the parameters of what we do. And then the delta, when you have a delta on these trades, you want a net delta of 0.25 or less. So basically, you don't want these to move too much. Unless I'm doing a trade the day after earnings, then I'll end up with a higher net delta. But if I'm doing my standard vertical spreads, I have a 0.25 or less delta. When do I exit these? I can hold them to expiration if the short caller puts out of the money. I can exit them at 40 or 50% of return, or 40, 50% of giving back part of the premium, or 50% of loss, or 1/2 the time. Sometimes halfway through these trades, if they aren't going anywhere because volatility is increased and time decay is taking away premium, but volatility is increasing it, I'll just exit the trade and look for another trade. So again, it's a very, very flexible kind of strategy. Here's the same thing with the puts. It's following the same principle, so I won't go into it in detail, but just to basically tell you that I'm selling puts or selling calls. And by the way, why do I do this instead of selling a naked call or selling a naked put? Well, the reason why you do is whenever you sell a put or sell a call, you have to have a certain amount of money in margin. This basically limits the amount of money you have to put aside in margin. Kind of like the Nadex stuff too. You're doing a spread. When you do a spread, it reduces it, the cost. The other thing is it puts in a built-in stop. If you were to do a naked put or a naked call, and you wake up the next morning and this stock's run 50 points, you can't put a stop on it overnight. This puts a built-in stop on your shorts. So really, most of us who trade options, unless we're just doing a day trade in the middle of the day, and I'm going to talk about that at the very end. We're going to invite you to some day trading of options. Bottom line is that I'll put this in so that I can sleep overnight. And most of the time, you will not get hammered in these things if you do good risk management and you really understand the charts. So I wanted to show you the 2 strategies that I'm going to roll through, and these are all trades that have occurred over the past week and a half. Just grabbed a handful of them that I've done and let you know. Yeah, and actually it's margin requirements, as Chris says. You're actually not paying any money for these. They set aside money, but the margin requirements are much lower on a credit spread than there are on individually selling puts or selling calls. And in my opinion, they're safer because you have that built-in hedge. So let's look at some of the things that came out of Blue's Money Machine over the past week. And these are just some of the trades. And again, I work part-time as a psychologist and part-time as a trader. I probably should work full-time as a trader. It's a lot more lucrative, but I like what I do to help people, and I try to help people here too. That's kind of my agenda, is to help people. So I want to show you a few charts and a few trades that went down over the past week or so, and just give you an idea of how you could pattern yourself the same way. And even if you already know options, if you're not doing this, I would encourage you to do this because it's a money machine, in my opinion. At least it's been for me. So here's a VIX daily chart. So you have a VIX daily chart, and this goes back to the 16th. I took the snapshot on the 16th. And what this is showing me, and again, use whatever kind of chart works for you. If you're a real candlestick person, do that. If you're a roadmap person, do that. I try to find things that works. I find that this quantitative analysis has worked extremely well for me with my options trading and even my futures trading, to be honest with you. I'm not here to talk about futures today. So basically, what this is showing me is you can see that the VIX was in a downtrend, and a lot of us know that. And this is the VXX, by the way. This is the ETF based on the VIX. I prefer to trade this than the VIX. I just have a partiality to it, and it seems to be very productive for me. It seems to have a lot of liquidity. I like to trade it, especially with options. So you can see we're in a downtrend, but you can also see here, and this is the quantitative analysis, see how this is starting to point up. By the way, whenever there is a red on a blue, it's an indicator to go short. Whenever there is a green on a yellow, now right now here you have reds on yellows, right? If there's a red on a yellow, you don't go long. But if there's a green on a yellow, and see the little green on the yellow here, the green numbers on the yellow, that's an indicator that it's now time to start going long. And as soon as I see the crossovers coming over here, that's the time I'll go long. And it's very, very accurate, very, very consistent. And again, I have it at the bottom of the slides if you want to reference this. I do it for the people who let me use it. Now here's one of the spreads I took on the VIX. Entered it on the 12th, exited on the 15th. By the way, a lot of these trades I expect to be in about a week or so. Some of these things, because of this quant analysis, I'm in and out. I mean, it happens so fast. But what I'm using is a computer to help me determine the direction on a particular instrument or on the futures versus me trying to figure it out or do the analysis in my head. So basically, I bought a 14 put on the VIX, and these are the AMAs, and I sold an 18. Was 10 contracts each leg. Well, it hiccuped one day and it moved real quickly, and there was an 85-cent credit that I took in on when I first took the trade, and then I exited. It was 55 cents when I exited, so I paid back 30 cents. So essentially netted $550 on 10 contracts. So I had to put up $4,000 in margin, put it aside in margin, and in whatever it is, 3 days you bring in $500, and that's a pretty good return, I think, on your money. Maybe I'm not, but maybe it's not for you guys, but for me it is. It's 550 divided by 4,000. That's giving you a return, pretty good return over a short time. And why are buying option VIX? It's already leveraged. Because I'm an options trader, Leon, and I want the lower cost. If you shorted VXX for 1,000 shares, it would be $18,000, whereas I did this for $4,000. So one of the reasons I do options is I get much greater leverage on my money. It doesn't require as much money, and also I have a built-in stop, and that's why I use the options. That's why I am an options trader as well. Here's another one just to show you. Here was the first chart, and then the trade came through, and then here was, you can see how the second chart where it showed that the VIX was coming back up. So basically it showed why that put spread worked, because a put spread, it's a bull put spread because you're selling premium, and sure enough, just in 1 or 2 days, boom, boom, and it was up and it hit profitability. That doesn't always happen. Usually it takes about a week, but it happened pretty quick. Here's another one. I'm just going to throw some of these at you to show how this can be a money machine for you. Here's Herbalife. Herbalife, basically, you can see Herbalife is below the 200-day moving average. This is a daily chart. And you can see, and again, this is not a quant chart. This is a plain old-fashioned E-signal chart with some moving averages on it, the green being the 13 EMA, and it's below the 20 EMA. And you can see how you had these, see the little wick there and the tail there. That's giving me an indication this wants to go down. It starts going down, and you initiate the trade. So here was another one. On this side, I'm selling calls. It's a bear call credit spread. So I'm selling calls, but I'm bearish, okay? It's the inverse. Took that trade on the 9th, let it expire on Friday because as you can see, it just kept going down. And these things will expire fairly quickly if you're front month. I just happened to be front month on this one. I was in the Aprils, and the Aprils expired. Well, they expired today, but really they stopped trading yesterday. So, the credit was 45 cents, $45. And, in a couple of days, whatever it was, in 3 or 4 days. It actually hit target fairly quickly. You could have exited this in a couple of days, just let it expire out. But that was $450 profit on a $6,000 trade in what I guess about 10 days. That was a little slower one. Actually, it hit profit before that. Another thing I do is combining those two trades. So I showed you a vertical bear call credit spread and a vertical bull put credit spread. Well, you can combine these two spreads. If a stock doesn't move that far, or if you want to take one side and the other, you can take both of these either simultaneously or take one, and then when the stock moves a certain thing, take the other side. Why not take advantage of your analysis? Now, it's very, very similar to each of these spreads. You still have a net delta. When you separate out your delta, it's still less than 0.25. It's negative in the puts and it's positive in the calls because the deltas are negative. And again, exits are the same at expiration. You can let the whole thing expire, or you can do 50% return or 50% loss or 1/2 the time. So you can combine these into what we call an iron condor. And so let's look at Netflix. So here's Netflix, and again, looking at the quantitative chart, looking at the charts, what this is telling me is, you see the 1, 2, 3, 4 where it's yellow, it's looking positive. And then, but you can also see where we have a little red on this number 4 right here. And so this is telling me that this could go up, but then it could fail. And again, I can't explain to you how I read these. I'm going to send you a link so you can learn how to read these. But bottom line is, I looked at this and I said, this may not be a bad iron condor candidate. It's one where you can sell the puts on the bottom and buy the calls on the top. I did both simultaneously, but here was the example of the trade. And all these, I tend to do 10 contract lots. You don't have to do 10 contracts. But basically, the trade was entered on the 17th. Basically, bought the 160 put, sold the 165 put. It ran up, took the profit off. And really, these kind of things you can often, when you're so close in, as long as that shorted leg doesn't go in the money, you can exit them for the full premium. So that was the put side of the trade. And then I did the call side of the trade. Bought the 190 calls, sold the 180 calls. These are all Aprils. Brought in a $1.30 credit on 10 contracts. When I got out, really didn't get out. I let it expire worthless. And that was a $1,300 return. So again, that's on, and again, these are only like, what was this, a couple of days, maybe 3 or 4 days. So a lot of these you can get in and out fairly quickly. You don't have to take the full premium. If you can, take it. If you can't, you won't. But there's another one of where I took the call spread and the put spread, I combined them, and I was able to bring in profits on both sides. So the thing I want to emphasize is how, once you understand how to do these trades, how profitable they can be for you. And then just showing you where Netflix was at the end. And again, you take one side, you take the other side, you get out. Pretty straightforward. And again, there was the whole Netflix iron condor. And again, these don't always work out. These were nice because they were only 3 days to expiration. So if you get out on 3 days of expiration, you do better than if you're not. And actually, I forget what this is. This number's a little off because it's, I think it was 60. I think it came out to 205 was the total amount. But anyway, just to give you an idea of how these kind of trades work. Here's another one on Google. If you know, Google went down into earnings and then went up after earnings. And I want to talk to you for a few moments about Google. As Google was going down, okay, and you can see there's the 18th. As Google was going down, it actually made a good call spread. As it was going back up on the day of earnings, it made a good upward trend trade, a puts trade. So basically, this is one of those things where Google ran up, you kept the premium, and then it expires worthless. And again, you're bringing in some profitability. Now, one thing I want to tell you about things like Google, think about this for Apple coming up. We got Apple, Netflix, Baidu, all these things coming up, Exxon, Amazon. One of the suggestions I want to make to you, if you know how to do spread trades, is don't trade into earnings. Wait till the day of earnings, catch the direction, and then do one of these kind of spreads. And you can even short sell that option right at the money. And if you look at your charts, and again, with an intraday trade such as the day right after earnings, I would suggest looking at 5 and 15-minute charts, not daily charts. But it's amazing how you can suck in the premium and you can take advantage of volatility and time decay, particularly on this Friday, because the ones that were coming out Thursday and Friday, they all expire, the options expire. But they're still very, very good trades. You can do these trades right after earnings. And volatility tends to drop quite a bit after earnings, so they turn out to be extremely, really, really good, really good trades. So I just want to suggest after earnings, think about doing that. Instead of, a lot of people, want to take these big home run hits into earnings. You can also get nailed on them. I've been nailed before. What I find is the day after earnings, selling premium is an excellent way to go, especially if you had, like we just had, where Friday was the expiration day. But remember, we have weekly options now, so you could do the same thing with a weekly option. The monthlies give you a little bit more wiggle room than the weekly options. But I would encourage you to look into these, and I'm really here to encourage people to look at this kind of trading. Here's Schlumberger. Schlumberger, again, you can see here where it was giving you an indication that it wanted to come down. It was a bear call credit spread, sold the 77, bought the 80.50, and actually this should actually show 20 contracts. Let me change that. That's actually 20 because I have times two. That was actually 20 contracts. Because it's only a $2.50 spread. So if I usually do 10 contracts, I'll double them with a tight spread like that. And again, you can see it came in. Next day it dropped, and right after the drop, you could exit that with a profit on the trade. The net delta, Don, is like the one you buy, like this one you buy and the one you sell. You take the delta from the one you buy and the delta from the one you sell, and you subtract it out. So if the delta from the one you buy, let's say, is 30, and the delta from the one you sell is, the delta from the one you sell is 30, the delta from the one you buy is 5, you subtract them out and you get 25 or 0.25. And they're all decimals. They go between 0 and 1. So you're just subtracting out the two deltas, all you are. So again, just a number of really cool trades. And my goal here is, because Morgan said, could you come and do a presentation? Had intended on being here a week ago. And I says, let me show these people. And Morgan's really cute. He and I joked around over the years. And he says, you got to talk more about Blue's Money Machine, Frank. You do a lot of this. I'm not out here to sell a service to anybody. I don't run out and do trade recommendations, although I probably should be working for a firm. I've had a couple of offers. Might actually take them up on one of those. I can generate trades all day long. But these are ideas I want to show you because I think they're just so neat. And then again, just to show you here how if you had a call spread like I did, this thing just tanked. And again, the other thing I want to tell you is looking at these quantitative analyses, it's basically telling me that this stock is sideways. It's under the zero line the whole time, and the quantitative analysis is telling me this thing looks like it has a downside bias. And then after the earnings comes out, sure enough, it does have a downside bias, a heavy downside bias. So one of the things I want to tell you is I use some of these tools like the quants, these quantitative analyses, to tell me what to do, and they seem to be very, very reliable. They're based on a bunch of these mathematical parameters and stuff, but I find it's really, really helpful. And I've gotten to where I don't even like entering before earnings. I like entering the day right after earnings because you're sucking premium out of those positions so well. Here's another one, eBay, if you remember, and this is interesting too. eBay is starting to show that it wants to go down. Now, this was before earnings. The earnings came out, and as you know, eBay ends up dropping after earnings. So what you do is you have eBay, it comes out. This quant was telling me, see the blue, the red on the blue, 1, 2, 3, red on blue? That's telling me this is going to go into a heavy downward bias, and sure enough it did, because you can look, and again, look what it did. And this is into earnings, so it's not based on earnings, but it's actually telling me ahead of time what could happen. So you don't necessarily, it would be nice if you were in this ahead of time, but you don't have to be in that ahead of time before that gap. You can enter it the day of earnings. That's what I did. You enter this in the day of earnings. It's heading down like crazy. You sell the 55 call, you buy the 60 call, there's only a 5-point spread. Boom, boom, you're out of it. The next day things expire and you made $600. That's a 10% return. And you can do these things, folks, over and over again once you know how to do credit spreads and once you get a good way of reading the market. A lot of people use candlesticks. I've gravitated to the quant. I found the quant to be this quantitative analysis to be extremely valuable to me. Another type of trade, and now those are trades that I took over the past week and a half. You can look at them. You can add up the amounts. Again, I'm not selling anything here. I'm just trying to educate. I became a psychologist to help people. Part of the reason I do this education, trust me, I could be working for a firm. I do it because I'll tell you how I got into this real quickly. I would have broker-dealers, and they were constantly losing me money, and they were salespeople, and I got so frustrated, and I'd bust my butt making $10,000, and they'd lose it on me. They'd proceed to lose it on me. And I finally said, this is ridiculous. I'm a pretty intelligent man. I've got a master's degree, a PhD. I supervise other doctors. I should be able to do some of this myself. Well, I've blown away every single brokerage agent that I've ever had over a 20-year period. But bottom line is, people can do this. It's not that hard to do. It takes some discipline. It takes some training. I'm probably somewhat gifted with this. Don't ask me why. I just am. And so I can really process this really quickly now. But I want to show you another trade. I call this blue century trade. And a lot of people know about this trade. But the century rule, basically, I didn't make it up. I just kind of did that tongue-in-cheek blue century trade. It's stocks that are at 90 go to 100. So what you do is you identify stocks that are approaching 90, and this works very, very effectively. What I would suggest you do is go to, it's called finviz.com, and let me write that down in here so you can get this. This is a free website. I love this website, by the way, and it's free. So you can't argue about that, right? And on finviz.com, what you can do is you can go in there and you can take these. Go in there, and there's a scanner they have in there. It's free. Go in the scanner, tell it you want optionable stocks, and then tell it you want stocks between 80 and 90 or 80 and 100, and it'll pull up all those stocks. You can hover over the stock symbol, and it will tell you, it will show you the chart on the stock. So I can go into FinViz and day after day find these, what I call the century stocks. And I just did this, I think it was Friday or Thursday, to put these slides together. And you can day after day use that FinViz stock and just pop through those things, unbelievable, and find these. So these are not around earnings, these are just stocks to watch. And the reason why I like to talk about these is these are really, really cool types of trades. You can go into FinViz, you can find a boatload of these stocks. By the way, you can scan it for P&E ratio, you can scan it for a lot of different things. You can even scan it to find out if earnings is coming up. So you can do a scan and get these types of stocks. I'm going to give you two of them that I found. And these are two potential trades for me coming into the next week. I think I've got three trades here that I'm going to share with you that are potentials coming forward here. So I'm going to leave you with a little gift here too. So basically you find stocks that are approaching 90. It's right there, David. See where it says Morgan has www.fin. Just click on that and I'll take you right there. And it's a wonderful website. I've been using it probably for 2 years. Really cool website. It's worth it to look at it. Don't get any payment from them, but I share what I know. So what I do is I find stocks that are, around 90 or heading toward 90 to 100. Make sure that the German market and the S&P futures are trending. So you want to make sure that your markets are trending upward. So why am I looking at these kinds of trades right now? Because remember, the market's kind of bottomed out. It's kind of flushing the toilet, so to speak. So now I'm looking for some of these kind of trades. I'm saying, okay, I have some potential trades. Now, I'm going to show you some credit spreads on these. It doesn't mean you can't do debit spreads. You can also do debit spreads on these. There's a reason why I do a credit spread. Two reasons, actually. One reason is, what if it takes a little longer for this trade to build up? I don't want to lose my premium by going long on those debit spreads, so I do a credit spread. So what I do is I sell to open the 90 strike put, and I buy to open the 80, and it could be the 85 or the 95 too, depending on where the stock is and where you're bringing in a premium. So you could do 95 by 80, or you can do 95 by 85, or you could do 95 or 90 by 80. And what you're doing is you do the front month. You short that 90, you buy the 85 or the 80, depending on what you can afford. Sometimes it's better to do the 85 because you get a better premium by doubling your contracts. So let's say, for example, I sell the 90 and I buy the 80. And that's a 10-point spread. And let's say, they're going to give me like, $3 premium. However, when I look at the 85 to 95, I get a $1.75 premium. Well, actually, if I did the 85 to 90, I would actually bring in, if I double my number of contracts, I'm bringing in $3.50 premium instead of $3 premium, because $1.50 times 2 is 3, and $1.75 times 2 is 350. So basically, again, I can go ahead and go in there and find out where I'm going to get my best premium. If it doesn't work out, I just take the premium home. If it starts to go the wrong way, I just exit the trade, or I can even hedge these trades. I won't go into that right now. However, the other thing too is, if I want to build up a portfolio, I can take delivery of these stocks at 90. Let's say I do this and I really think it's a good trade and I want to have a position. I can take this swing trade or the shorter term trade, and if I still think it's good, roll it into my portfolio, and I can actually do covered calls on these things. So this is a really cool trade. This is a really, yes, and the front month is the current month, correct. which, well, and you can do this with weeklies too, by the way. Know that you can do these with weeklies. I just do the monthlies because it's what I like to do, and I like some time for these trades to build. If you're very familiar with the weeklies, you're perfectly welcome to use weeklies on these. It's not going to hurt you. So here's Hershey. So I'm going to give you a couple of trades that I'm looking at now. Here's Hershey. Now, Hershey is very, very bullish looking to me. Hershey also has earnings coming out. We'll talk about that in a minute. But you can see how it goes 1, 2, 3, 4, 5, 6, 7, 8. Notice how you have the 1, 2, 3, 4, 5, 6, 7, 8. Remember I said that there's stages. So typically a stock will move 6 to 8 in one direction, then it'll pull back. So you could have a little pullback in Hershey here too. So again, this might be something that you might want to wait for the pullback before you take the entry. I'm thinking that because Hershey has earnings coming up next week, Hershey could rally into the earnings, particularly if this market comes down. So I would take this trade on Monday if the market bottoms out. As soon as market bottoms out, if Hershey holds, take this trade or pulls back to 87, take the trade, get out the day before earnings. Okay, so it's a very short-term type of trade. You can take these over a whole month too. But this quant is telling me that despite the fact that it's getting overextended, this has been extremely positive, and even when it goes a little negative, it's not collapsing. And it looks to me like they're going to push Hershey to 100. That's the kind of way to kind of look at that. Now here's Hershey. So earnings is coming out before market open on the 25th. You short sell the 85, and this is one of those 5-point spreads. Remember I told you I can do 85 to 90? Because the premium is so good going into earnings, this one I'm only using a 5-point spread. So I did 10, I'm going to do 10 contracts. I didn't do this yet. This will be coming up Monday. Assuming the market does not bottom to 1500, or as soon as it bottoms to 1500, I'll jump on this. You can buy the, and actually this is reverse, I'm sorry, this should be 80 and 85, and this should be 90. Little typo in there. Let me correct that real quick so it doesn't cause any confusion. So if you got the download of the slides, just know that these are inverted. Bear with me, I did these always at night. So I short sell the 90, I buy the 85. My net credit is going to be $1.30. So on 10 contracts, you don't have to use 10 contracts, you can use 3 contracts, but basically it's $1.30. I can get out of these. Remember what I told you folks, these are Mays. You can do weeklies, but I wanted to do the Mays. I can get out of these at 50% of that credit. So I do this on Monday, let's say, for example. I take in the credit. Hershey runs up 5 points. I don't ride this through expiration, and I don't ride it through earnings. I take 50% of the profit before earnings. I can make $650 possibly in 2 days on this trade. Now, would I take this trade again? Sure I would. What's probably going to happen, Hershey could run up to 100 at earnings. And then a lot of times when it goes to 100, it can go to 110. So again, this may give you a couple of potential trades on Hershey here. But my plan for this is get in. As soon as the market, if the market shows it's going to support on Monday or it bottoms out and then comes back up, take this trade. I might switch it from the 90 to 85 to 85 to 80, depending on, I don't want this to be too deep in the money, but I would actually short this if it's a point in the money or 2 points in the money, because it's a very rapid fire trade. With these kind of trades, because earnings is coming up, I'll get in and get out in a couple of days. But if I make 50% profit on this, I'm not going to be greedy. I'm out. That's my rule. Get out, especially with these short-term trades. So watch Hershey. I think this particular trade, and again, understand that you have this in the slides. So I'm going through them fairly rapidly to kind of get Morgan caught up here a little bit. I don't want everybody to fall too far behind. So these, you can review these again with that projection I put in there for you. The quantitative indicator, it's in the slides. Just look in the slides. I've got all that information for you in the slides. Just download the slides. That's fine. That way I don't have to type in a bunch of stuff. And you'll have it there. And so that's the Hershey one. I think it's a really, really good trade. Now, again, Kurt, I don't worry about the volatility on these because of what I'm doing here, because I'm going to be out. Where I would worry about volatility is if I was doing, going to be in these longer for a couple of weeks. But right now, I'm not worried about volatility. Yes, I wouldn't typically do these. I'm only doing these because these are the century trades. Also, one other thing is that I will also look to possibly do a trade like this right after earnings. Let's say Hershey's pulls back. Let's say Hershey's goes down 5 points after earnings, and it starts to rally up the day of earnings. It rallies up on the 25th. Go take this trade on the 25th. You've got through from May to it finish. If it gaps down 5 points, let's say it goes up to 95, then it goes back down and gaps down to 85. it'll often fill the gap. If it doesn't continue that gap, it'll fill that gap. You can go in there and take the same exact trade or a variant of it again. And again, the day right of earnings is a really cool day to do one of these kind of trades too, because volatility is going to drop pretty significantly. Now, one other thing I want to tell you about this is I'm actually combining two strategies here. I'm combining heading into earnings strategy with a century trade. You can do these century trades at any time. These are just the ones that came up in my scanner, and I saw some potential on them. There's many other ones there, okay? I'm doing these because I want to help you out just coming into the next week. Here's and by the way, the quant isn't available on all stocks. You have to go to their direct server to get it. So, but I showed you Buffalo Wild Wings, and just what I'm showing you here is that it's a very, very bullish pattern, probably due for a little pullback, but notice how it's approaching 100. So we have another potential trade, and again, you don't have to take these next week. You can see how they behave around earnings and take them again. And again, poor Blue Horseshoe, I think he needs a vacation. These both should be 100. So. And I'll project these again when I'm done because I found a couple of typos, so I'll correct them for you. So you can download them, and I'll put them in there again to download for you at the end of my presentation, so you'll see a few of these. It was pretty late when I was doing these. So bottom line is Buffalo Wild Wings, same type of thing. You know, you're short selling this should be 80, I'm sorry. Short selling the 90 and doing the 80. So you short sell the 90, you buy the 80. And by the way, this is a huge spread. So you could do 90 by 85 too. I just thought, why not make quicker money faster? The wider the spread, the quicker I'm going to take my profit and run. Basically, the credit on that as of Friday close was 225. You know, if you can strip 50% off of this in a week, you've got it made. Don't even ride it through earnings. Just take that profit off. But what I've done is I've taken the century trade and I've combined it heading into earnings. If this market bottoms in one day, and I may not take these first Monday morning, I want to see what this market does. Remember, I look at the market. I might take this Tuesday morning or Tuesday afternoon, be in and out. Buffalo Wild Wings gives you a little bit more time than Hershey is because Hershey's earnings is coming out on next Thursday, whereas Buffalo Wild Wings is the next Monday, I believe it is. So it gives you a little bit more time. But I wanted to share these trades with you. Oh, and AMC is after market close. Thank you, Steve. BMO is before market open. AMC. I usually teach that in my class, so I forgot to say that to you. And then here's another one I'm looking at that looks real interesting. A diagonal put calendar spread. And I'm looking at gold. Gold has retraced. In fact, let me show you the little chart here, then I'll jump back. Here's a chart on gold. Now this is GLD because I'm going to trade the ETF. Gold had this couple of gaps down, came back. If gold fails right here, if it fails to fill this gap, and it fails at the top of this candle when it gapped down, then that would be an opportunity to take a diagonal put calendar spread. If it doesn't fail, don't take this. Take a call calendar spread, okay? Take a call calendar spread. So do the same thing with calls instead of puts. So I'm just watching this. I'm going to show you the one that I'm watching now because there's a lot of data suggesting to me, and I probably should have put the quant on this. I thought I did, and then somehow I erased it. The quant is kind of still mixed on this. Gold still could be going down. So what you do with this is you buy an out of the money, at the money or out of the money put 3 to 6 months out. So we might be looking at September on these. Then we short sell an out of the money put. Now these can be a weekly or a monthly. By the way, you could do the exact same thing with the calls if you think this is going up. This is a longer term trade. This is where I'm selling premium on the front month or the front week and holding that longer term position. You know, if gold really is going to take the nosedive that it looks like it is going to take, then September would be a great time to own puts on it. But in the meantime, when you take that put position, you could do that. Now, I would suggest if it breaks above that high and it looks like it's going to fill the gap, do a call calendar spread. Okay. If it looks like it's going to start to back the other way, do a put calendar spread. Also, you have to look at volatility. You want to make sure that the front month has more volatility than the further out month. And that's really what I mean by volatility skew and surface volatility. So you have two different strikes at different months. Typically, because gold has been so volatile lately, you will see that the volatility on the weekly or the monthly of gold, next week or May, is much higher than the volatility in September. So basically, we want the one we're buying has lower volatility than the one we're selling. So we kind of take advantage of time decay and volatility. You want to bring in at least 25 cents credit. you'll typically bring in more than this, but you want to at least bring in like 25 cents on these things. And then each time it moves in your favor a point, you're going to get 25 cents. A lot of times when I subtract the deltas out on both of these, I like to get about a 0.40 delta. So I like a pretty wide delta if I can. Now what you do with this trade is you collect your premium for the weeklies or the monthlies. You collect that front month weekly premium, and then you exit your long trade 2 months out. So you exit the one that you bought to open, well, say long, exit your long 2 months out. So I could do this trade now and then hold it to about maybe beginning of August and then sell the September or roll further out, assuming that the move hasn't already been made. So those are a couple of different trades that you can do and can get different trades on this. You can also do credit spreads on this too. Nothing stops you from doing credit spreads. In fact, I'm planning on doing a credit spread on gold. I just wanted to give you another kind of opportunity. So that being said, and I'm trying to go fast, so I'm not right. So what you're saying is you're buying an expensive put and selling a cheaper one. Correct. And what you're doing is when you sell that put, you're bringing in that premium each month. So you bring in the premium, bring in the premium, and a lot of times that will pay for your trade. And it's very interesting how you can do these trades. I did an options class Thursday and Friday, and I was showing this to my students and how you really could do a gold trade on this and be bringing premiums in for 6 months. Actually, if you look at the weeklies on these, it's very interesting. If you look at some of the weeklies, within 2 to 3 weekly premiums, you could actually pay for your long-term trade, believe it or not. Really, really cool. Really, really interesting. The quant indicator and the TTM wave are two different things, Frank. The TTM wave is John Condor and Hubert Center's indicator. You can get it free with a lot of the packages now. Thinkorswim, they used to sell it. It's a good indicator. The quantitative indicator is much more sophisticated, and it's computerized, and it comes direct off a server. I've actually used the TTM wave. It's not bad, but I found the quant indicator being much, much more effectively. Right, and that calendar spread is a debit spread, by the way. But I'm actually setting up a credit spread on that one too. Actually, to be honest with you, I do more than one trade sometimes too. That being said, Tom has asked me to invite you, and Morgan, if you want to project this, he's got what he calls the irrational exuberance trade. I'm usually not with Tom all the time because I'm busy doing my thing. But this Monday night, he's going to show you what they call the IR trade, or the irrational exuberance trade. It occurs within the first hour of the day. Okay, it's what they call based on reference bar 1. The BTI calls reference bar 1. And it's cute. We say he actually has an indicator called the horse race, which I think is cute because my nickname is Blue Horseshoe in the fifth, so it's kind of cute. It's free. You could go there. He's going to show you this, and what he's doing is he's showing how you can use his strategy on how you can do a day trade on a stock in the morning, and he asked me to come by and show you how you could actually day trade an option on it. So if you get a chance to do that, please feel free to do that. It's free and it's worth it. Also, he says if you fill out the survey right here, you get a free audio of his first book, which is a great deal, winning the day trading game. So if you fill out that survey at DTI, they'll give you a free copy, and it's a good book. I do this. I fill out the survey. I don't care if you don't do anything with DTI, just for the audio book. It's like a $10 value. So it's really, really cool. So if you get a chance, please come to that. Tom asked me to come by on Monday night to talk about this from an options standpoint. So I'll be there Monday night at 7 Central. And then if you fill out his roadmap survey, you also can get his free audiobook. And also I'm going to give you one more offer and talk about doing nice things. I'm going to say learn how Blue picks the winning horses, okay? I'm going to give you more free education. I'm not selling you anything, by the way, here. If you notice, that's not my goal. I want to really educate, all right? So what I'm doing is go to that, open up the that website. I think I still got it here. Let me see if I've got it. Just go to that link I gave you, and see if I think I've got it right here. Yeah, here it is. Just click on this link, and it'll take you right to my slides, and all that information. It's in the notes section on my slides. Okay, so it's in the, if you want to get anything or want to look back over where this link is for the DTI thing, it's right in the notes section on my slides, on my PowerPoint slides. So I'm giving them to you. This Tuesday night, every Tuesday, I meet with my students between 5 and 6. I'm going to probably extend this from 5 to 7. You can go, the website is www.dti.omnovia.com/options. And again, What you can also do if you want is you can just download my slides and cut and paste this into your thing. We will take the password off on Tuesday. Usually there's a password on this. It's a paid service. You can come in and I'll show you some of the stuff that I'm looking at over the next week. We're looking at some earnings trades. And then in addition to that, I'm going to be talking more about teach you more about how I use these indicators to find the winning horses, so to speak. So we've got a lot of horse race stuff going on for you. Don't know how this came about. You know, it's the time of the year for horse races anyway, so that's kind of interesting. You know, they have the Kentucky Derby, as it's called. So, but again, if you want to go there, just go to that link. Go there Tuesday now. You don't have to sign up for anything here. Just go there Tuesday. Put it in Tuesday night. Do it probably around about 4:30 Central Time, and I'll make Adam take the password off. You can come in, you can hang out with us, see what trades we're looking at for the next week, or I'm looking at for the next week. And I'll also, after that, spend time during the whole thing showing you more how I use my quantitative analysis to pick winning trades. So I wanted you to get some benefit for that. So I'm not just leaving you hanging here and just giving you slides. I want to help you learn this stuff. I've been very blessed to have this be so productive and profitable for me. So I want you folks to also have it. And that's Central Standard Time, CST. So Central Standard Time. So it's basically Eastern is 6, Central is 5. Just go to that website. Go to my slides and you'll see it for the quant indicators, and you can read about it and learn about them. They're fairly easy to use. I need easy sometimes, trust me. Let me see if I can post it in here again for you real quick. Well, actually, just do my slides. If you click on my slides, you got all the information. Look in the notes section. Underneath each slide is a note. It will be a white section, and you'll have everything in there that you need, okay? And you can go cut and paste whatever of the stuff you need out of there. I think that's the easiest way. And then also, please come Monday night. You can learn about the irrational exuberance trade. So what we're going to be doing is showing you how to get up a nice trade in the morning. Tom and I are. And then Tuesday afternoon, I'm going to show you some more options to trade. And we'll be talking more about options trading. So, I mean, and look these trades over. You can kind of analyze how we do this. It will ask for a password right now, BC. The password will be taken off on Tuesday, okay, because that is a password-protected room. It will be taken off Tuesday afternoon. So right now we're not going to be in there, but Tuesday afternoon, 5 Central Standard Time, you go in there. I'll probably have Adam take it off like 4:30. So I'll have him take it off later, and probably after the market close, 3 o'clock Central, and then you can go in there, right? So it'll let you in, but you got to do it that day, and that's why I'm giving you these slides. And again, please come visit me. It'll be fun. Come visit Tom and I on Friday nights. You actually get 2 nights with Blue Horseshoe. You get him with Tom Busby. That's a real winning combination. And then you also get me again on Tuesday. So I'll share some of the stuff that I do on a regular basis with the students, with you. And if you need to reach me, I keep creating emails because I get too much junk mail. Trader Shepherd is a new handle. I'm not just Blue Horseshoe. I'm the Trader Shepherd. I have a video on YouTube. If you look for Trader Shepherd, I'm going to do the presentation again for everybody. I think I did it here. Morgan, is that the one I did here? I'm not sure whether I did it here or not. I think it might have been the Saturday Breakfast Club I did it, but I'll do it again. It has to do with the psychology of trading, and so that's kind of my handle as a human performance psychologist for the traders, Trader Shepherd. So I lead you into green pastures. How's that? And make you avoid the wolves, basically. So anyway, feel free to email me there. And again, my email's in the listing. I'll open it up for questions. I really wanted to move quickly because I didn't want to have you guys run over. I know things are running over, and I'm giving you my slides to look it over. If you're new to options, contact me. I'll set you in the right direction for trading options. You don't have to spend a lot of money on your options education, by the way. A lot of programs, $10,000, $20,000. You do not have to spend that and learn how to do this stuff. I mean, to me, I did it myself. I spent that kind of money. I thought it was the biggest scam around. You know, you can learn the basics, learn a lot of the intrinsic stuff, learn the underlying, learn it well, and do it for like $1,000 to $2,000 and live. Do not go and buy those $10,000 and $20,000 courses. You're spending far too much money. That's all I can say. Anyway, yes, I do futures too. In fact, Leon, if I get enough of a demand for it, I will show you how I use the quant to trade futures a little bit Tuesday night. How's that? Just remind me, Leon. His old Blue Horseshoe, sometimes, the blood ain't getting to his brain sometimes, I think, so he forgets stuff. He doesn't eat enough alfalfa. So, yes, you remind me. Yeah, I do futures. In fact, all next week, During the day, one of the other DTI students, Charlie Prince, is going to be with me, and he and I are going to do quant analysis futures trading all week long. We actually want to prove that we can make a large amount of money, and then we're going to show people what we've learned. And we think we're going to be very on target with this using those quantitative analysis. Anyway, I hope this has been valuable to you. I know I've talked quickly, but I didn't want to have you guys run over because I know it's later. It's actually 4 o'clock Eastern time. I have to write a couple of neuropsych reports up today, and I might have to run over to the church too in about an hour. So anyway, you guys have a great afternoon. Thank you guys for coming. Thank you for listening to my gibberish, and I hope you learn how to have your own money machine the way Blue has learned how to have his money machine. So feel free to contact me. Feel free to download the slides. Learn how to do this stuff, and don't be spending a whole lot of money on expensive classes, please, folks. The link is also in it, but I'll give it to you again, Ron. Hang on. And again, if you click on it now, it will say there's a password, but there will not be a password, and it is in my slides too. So if you just access my slides, you will get access. Let me broadcast my slides again. And again, all the stuff, even the link to the irrational exuberance is in my slides. So if you didn't get anything, things are scrolling too quick for you folks, don't worry, they're in the slides ready for you to go. And let me project the slide thing again for you real quick, just so you'll have it. And all this information, the Monday night meeting, the Get Tom's free book, it's all right in my slides, and that's why I'm distributing them. That way you can look at it with your time. I'm at the tail of the day. I know you guys are probably exhausted from all the wonderful information you heard here today. Okay, let me put it in here real quick for you. And click it here, and we'll get it. We should get it. There it is. So you can click on that, and that'll take you to my slides. Thank you, Donald. Thank you, Donald. Donald was in there. Yeah, Donald was a nice active participant in the classroom. I enjoyed having him in there. Okay, good, good. Yeah, it should load 2004, 2005, and I'll see after I log off. I don't know why my PDF converter was not working. I was going to put it in PDF for you folks too. Anyway, you guys have a wonderful rest of day. Thank you for listening to me. Doug, good to see you again. Haven't seen you in a while. Doug's one of my buddies. He bought me a propeller beanie. Still got my propeller beanie, Doug. Put it on whenever I need to laugh. Anyway, you can't open the link, this link here that I just gave. Let me double check here for you. Hang on. The link for the slides is not opening. Let me double check. See that myself. And if it doesn't, then I'll rectify it for you. You should be able to open up that. Here's one. Let me see if it should open it right up. Let me see if it does. I'll double check for you. Yeah, it opens up. It went there, pulled up. Now you might want to download it and then open it. Sometimes it opens slowly, but it's slowly opening for me. Or download it and then download that. And yep, it did open it right up. So it is opening. You might have to right-click to open the app. But it is opening. I just double-checked to see if it opens. It's opening. So it is opening for you. So it could just be something quirky. I double-checked it for you just to be sure, and it looks like we're good. It is opening. So anyway, and there's Tom's thing too, just in case you need that. That's at the end of my slides. But you got it all in the slides anyway. So you guys have a wonderful rest of the day. Like I said, thank you for coming and listening to my gibberish. What do I use for the weeklies, Frank? I use the VIX. I use my 5-minute and 15-minute charts, 5-minute, 15-minute hourlies, and I also use the quants. I use those quants on a 15-minute chart. So I also have 15-minute quant indicators. But go to that link and you can learn about it and do what you need to do. Well, I hope that was valuable to you. I know I went through a lot. If you're new to options, I know that's going to be a little bit for you, but learn options, man. I'm telling you. Create a money machine like I do. I look at my money machine like the red boxes that keep spitting out those DVDs, man. I haven't, but I probably could, Leon. coming on Tuesday, and I'll look it up for you. I do a lot of those ETFs as well as other things, so I do a lot of them. I like the VXX and I like the XIV, to be honest with you. What about butterfly finish? Yeah, actually, that's a little bit too much to go into a butterfly. Where Dennis, go to that link. Go to my slides. When you go into my slides that I put the projection on here, look onto the white on the bottom. I've got the links wherever I get a chart from. I put the link. It's right in the notes section of my slides. Okay, just open up those slides, go into the slides, and look at the bottom where it has the notes, and all that stuff is right in the notes section. So anyway, you guys have a great day. I guess I'm the last presentation. Handing it back over to you, Morgan, and you guys have a wonderful day and be safe. Glad they found those guys in Boston. I used to live near Boston, so I feel sensitivity to those guys.
All right, very cool. Well, Frank, we greatly appreciate you being here. You did an outstanding job wrapping things up for us today, being the closer of the day. So again, if you guys, I told you were in for a treat with Frank, and he definitely delivered. And remember, two things Frank mentioned. There's going to be a Monday night session is number one, and I'll type the link in for that again for you. If you downloaded Frank's slide, you'll have all these. And then the second thing is that Frank invited you to see his session on Tuesday night. And one thing to remember with Frank's session on Tuesday is you just save that link, and on Tuesday night they'll remove the password. So if you try to get in it right now, obviously there's a password on. But again, Tuesday night, try to log in, and I'll type the link in for that. But Frank is actually the guy that taught me pretty much most of all the stuff I know about options. So I'm grateful for that, and he does a great job. He's been on the TradingPub several times. Always does an excellent job of educating and sharing with others. So there's the link to the options room if you want to write that down. So Frank, thanks again. I hope you have a great weekend. I'm so glad that you guys stuck with us today, and we'll get the recording up as soon as we can and try to get the email out to you as well. So thanks everyone. You guys have a wonderful day. When we shut the room down, it'll